Welcome to the MUFG Global Markets Podcast. I'm George Goncalves, Head of U.S. Macro Strategy at MUFG, and I'm joined by Bill Matthews, who's a Senior Analyst and part of our High Yield Credit Desk Analyst team. It's Wednesday, January 19th, 2022. Great to have you on, Bill. This is your first time as well, so thanks again for agreeing to come on the podcast today.
Thank you, George. I am excited.
Good stuff. No, listen, as a reminder for our listeners, this is the third part, the last in our series of our 2022 Outlook recap on U.S. fixed income markets, tied to the recently published 2022 Outlook, which Bill also contributed to, where I'll be interviewing our desk analysts and bond experts that sit on the various desks at MUFG. So, with that said, Bill, why don't we start off with our baseline views for high yield spreads and in the context of pros and cons at the overall index level?
Sure. So I would say, right now we're in the midst of a massive repricing of all asset classes, and high yield's not immune from the downdraft that we've experienced. We remain constructive on high yield relative to other asset classes, because high yield carries less duration risk. And right now, I think the biggest risk in the market is duration and not credit. The unwind of decade-long global central bank easing policy is causing unease across all asset classes. And strength in high yield is going to be underpinned by strong corporate earnings, low default rates, and the moderate interest rate risk characteristic of the index. So, offsetting those strong fundamentals would be where we are kind of on a spread basis. And our forecast range for 2022 was for an OAS spread of 285 to 385. And right now the index is currently sitting at 295. So we're at the tighter end of the spread. So we have strong fundamentals, a limited duration exposure, valuation that's kind of fully valued. So we still are constructive on high yield. We do feel there'll be periods of volatility which will cause spreads to widen, and those would be periods to increase weighting and or extend on duration. But for right now, we still feel it's attractive, but just at the tighter end of our spread range.
Thanks for that, Bill. And I do think it's going to be an interesting year, as you point out. I mean, it's part of our overall thesis from the macro side that a tale of two halves, where there's going to be continuation of growth in the first half that's going to be more akin to what we saw last year, then some deceleration. But who really knows? And at the same time, this sort of macro volatility at times will lead to markets repricing things. And like you said, high yield's not immune to it. Why don't we drill down a little bit further and discuss some of the other views and sectors that we focus on here at MUFG in the high yield bucket?
Yeah, so from a sector perspective, I think the framework I'm comfortable with that I think is helpful is if you look at some of the metrics on an aggregate basis in terms of what's the leverage for a sector versus the enterprise value multiple, or where the equity for that sector is trading. And that gives you what I would refer to as a loan to value, meaning how much of that total enterprise value is being consumed by the leverage component. And obviously, if that number is lower, that means there's greater equity cushion below you, which provides support for in the event that valuations come in, markets go down, and so forth. So I like to look for sectors that have a low loan to value. And then an additional metric to look at is spread per turn of leverage, or how much of that adjusted spread are you getting when you compensate for how levered the company is. And if you put those metrics together, I think we find industries such as the basic industry, capital goods, technology, consumer products, those are industries where your loan to value is between 20 and 30%, but you're getting a decent spread per turn of leverage between 90 and 140 basis points. Within those sectors, there's obviously individual names that are trading rich or tight, or have different characteristics of their business. but we find that there's really good opportunities in those sectors to find names that are defensive, that provide you, what I would say is going to be at least an index type return with lower than index risk. Conversely, I think some of the sectors, transportation, retailers, where the leverage is consuming more of the enterprise value multiple, so the loan to value is higher, and automotive in particular, where that LTV is higher and the spread is lower, doesn't really compensate you for the risks in those sectors. So I think that would be the framework where we would start, and then from there start to find some individual name ideas.
Thank you for that. I mean, I think that's a very interesting approach. I've always found your explanation of the LTV concept as a kind of good way of distilling a topic and a concept that using enterprise value sometimes can be confusing. Why don't we kind of wrap up here? I'm going to ask you the same question that I've asked the others in this series, and we're already seeing a glimpse of it, and as you alluded to in the opening as well, that 2022 is starting off on a kind of down note. I mean, we have most of the major market indices lower, both in equities and fixed income, and very rare to see a wholesale decline in all fixed income products. Largely, like to your point, duration related, but there's been some spread widening and just some spread concern, especially considering what's been going on in mortgages, and will there be a leak through back to investment grade and eventually into other credit. So I'm going to ask the same question. We're seeing the first kind of round of financial conditions tightening. If this were to last, you kind of answered it a little bit in the first question, but how does that kind of change or impact the fundamentals for high yield credit?
Yeah, and again, high yield not immune, not only from a yield perspective, as there is a treasury component that's incorporated, but just from a spread perspective. I think we exited 2021 at a 283 spread in the index, and now it's out to 295. So in a brief period of time, we've seen some spread widening after a very exiting 2021 at a very tight level. I think that there's a balance between perception and actual execution and follow through, and the Fed uses that balance to its advantage in terms of vocally telegraphing what it will do, and maybe the markets correct ahead of the need for third or fourth tightening. So clearly the fear is that the tightening happens too quickly, and whatever economic growth that was developing is choked off while inflation still remains present, especially in the labor markets. So I think it's developmental in terms of seeing how things progress throughout the year. But again, the biggest risk in everything we've talked about is really the duration risk. And I think the high yield market provides protection against that in its, larger spread, especially in certain sectors where your spread per turn of leverage is particularly attractive, and it's shorter duration. And especially now I find that, there's some decent, mid single B, low single B names that are yield to call 22, 23, 24 that have a yield that's not too far inside of the yield for the entire index. So for much less risk, you are earning an annualized yield that is commensurate with what the index is. And I think, during these periods of volatility and uncertainty, that's how you outperform the market, by having a more defensive portfolio that has less risk than the index that performs in line with the index.
Thank you, Bill. Really appreciate you coming on and chatting with me. Kind of summing things up, it feels like high yield could weather the storm a little bit better, or given the cushion and just the way that the sectors, various sectors will give you opportunities to kind of weather the storm better on a defensive basis, as you describe things, does kind of suggest like you kind of buy the dip is really what you're getting after. So I really appreciate all of your comments and the efforts into the 2022 outlook. For those that have not had a chance to go through the outlook, please check out our 2022 macro to markets outlook report, where these points as well as charts from Bill are there. And also, if you haven't had a chance, This was the third of a three-part series. Please check out the IG podcast as well as the mortgage podcast. Lastly, we'd like to remind our listeners, for those who would like to receive our strategy reports directly, please email your MUFG sales coverage or get in touch with myself directly on email or Bloomberg. Thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts, and reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.